Okay. A little audio problem just then. So yeah, let's just start over again, guys. Anyway, I went through what the presentation is going to be all about. Sorry, we were on mute there. I don't know what I hit. But anyway, Haral, this is Haral Galani, CEO of StockEarnings.com.
Hello guys, you know me from emails, and today's absolutely pleasure meeting all of you. And today, Ryan, who's a stocks earning employee and he's been trading for a long time, then we have Mitch here.
Mitch, say hi.
Hey guys, how's everybody doing? Looking forward to talking to you in a bit, and I think I got an action presentation for you, so I'm going to go back and get ready, and I will see you guys in a bit.
Sounds good. All right, cool. Anyway, guys, like you said, you got introduced to Haral there. My name is Ryan. I'm going to run you through the beginning of the presentation by showing you some new upgrades to the website. And then what I'm going to do is take Mitch, and he's going to give you some step-by-step trading criteria for trading earnings. Sorry you guys only saw my mouse before. What I'm doing here is just leaving the disclaimer up for about 20 seconds so you guys know. I'm sure you've seen this all in other webinars, but hey, just be careful. I'll leave this up, and I'm going to talk just one more second about what I'm going to talk about. I'm going to show you what the new website's going to look like. Really all we're doing is upgrading the current software, and we got a couple of complaints that moves a little on the slow side. So what I did was, what our team did is speed it up. I came up with a couple of new features, so I'm looking forward to that for everybody. So I'll profile that a little bit, and then I'm going to get into just some actual little bit of trading strategy before I turn it over to Mitch. And I think we're okay with the script, with the disclaimer now. So I'm going to get right into everything, and I want to jump right into content. I know it's depending on where you are in the country. It's 8 o'clock here on Wall Street, and so I want to show you our new upgrades we made. We're solving a decent amount of problems with speed and then changing some of the screener. You'll see this looks pretty right? So on the bottom part, which is I'm going to go into what's the premium version of it, right?
You can show them the current too right now.
Oh, sure. Yeah, that's a good idea.
So just click here.
So here's what it looks like now with the box here.
Design, yeah.
Old design.
And very slow.
And a little on the slower side. I don't think it's very slow, but that's just me. Yeah. Anyway, and then here, this is going to be much faster.
New one, which is going live now. 1 week.
In a week or so. And, so I'm going to run right through a scan and kind of just profile the two strategies that Mitch is going to be getting into, and you'll hear us talk a lot about on volatility rush and volatility crush. And actually, since I think I should probably get to both. I want to try and turn this over to Mitch by 8:15, and it's 8:06, so let's see how far I get. So let me run a brief scan on this. And then also, at the end of Mitch's presentation, we're going to leave some time for Q&A. So if you throw your questions in there, I don't want to necessarily interrupt Mitch, so I'll try and get to them all at the end, but feel free to put them there, and I promise to try and do my best to get to all of them. All right, so I'm going to just scan using NYSE and NASDAQ, and let's just look at tomorrow's earnings, and I'll give you an example. Okay, we go to Monday, right? Thank you. And what I'm going to do is look at our predicted move. And I'm going to do one with max of 4 here, right? Why am I doing that, right? Since we're going to do a volatility crush, what a volatility crush is selling premium into earnings, right? So if you guys are familiar with buying options or selling covered calls, we want to sell a vertical spread into this. So give me a second here, and I'm just going to scan using our proprietary indicator, the predicted move. I'm going to do a predicted move between 1 and 4%. So we actually want a small move in this. We want to use this to identify our strike prices, right? So then I'm going to do only weekly options. And let's see what we got back. And then I'll show you an actual detailed example. Oh, sorry, hold on one more second. I must have left out a parameter.
So this is a volatility curve. In this strategy, we expect, we expect stock not to move so much into earnings.
Perfect. Okay, it worked there perfectly. Sorry, guys, I was just wanted to make sure I had it correct.
And
So,
they can download from here to this column.
sure, yeah.
This column.
Oh, sorry.
So this is the way you can easily download the data into into Excel or anything like that.
Perfect.
Yeah, in a new version. This is going to be going live in 1 week.
Awesome. All right, cool, guys. So let's grab an example here that's got like a low move. Let's go between 1 and not sure. Let's look at 1 and 3, 1 and 2. Merck. Yeah, I mean we can use Merck between 1% and 2% expected move, right? So then simply all I'm going to do is go over to analyze. And then this is for tomorrow, so I would have had to actually sell these already, but this is just an example, right? And then what I want to do is sell a vertical spread into this. Right, so it's on vertical, and I would use tomorrow's expiration. Right, and then I would have sold a 62. So if there's premium above, let's just say $6, right? So 68. There might not be any yeah, the numbers are all messed up because it's overnight session. But basically what I would do is sell a vertical spread above and below current price, but using our expected move indicator, right? And then, let me go back to this. So if it's 1%, I would go 1% above current price to sell a call spread. And then I would go 1% below current price to sell a put spread. And I would ideally even try and give myself a little bit more room. But with options expiration so close, we would look for that, ideally for the stock to move very little after the earnings announcement, and then just let the option expire worthless, or essentially if it does move in a direction that makes one side cheaper and we can always buy it back. So you know what? I think we're moving a little fast, and instead of using the time we have to get too detailed into strategy, Mitch has got some pretty detailed step-by-step ABC kind of stuff. So I'm going to turn it over to Mitch in just a second here. So let's let him do a test of his sound, and then we're also going to notify you about when the upgrades to the website happen. So you guys look out for that, and then I'm going to turn this over to Mitch in just a second, and give me a minute here. Hold on 1 second. Yeah, that's pretty good. That's good. The staff. All right, we are good to go. Over to you, Mitch. It says self-muted.
Hey guys, can you guys hear me? Alrighty. All right, give me 1 second here. All right, let me get my screen share up here and we will get going. All right. Can people see my screen there? All right. Okay. All right. So you guys already heard the ubiquitous disclaimer. So we're gonna move right along here. As we discussed, and as Harel laid out when he sent out the emails, the title of this thing is "Timing is Everything." And basically what I'm going to do here is go through various elements of what has become one of our favorite trades in association with earnings, and that is the volatility rush. We're going to talk about this in depth and show you a whole bunch of things that we have brought into this as a result of our experience in trading for a number of years, and combining that with the excellent content that's on stock earnings. I'm always a fan of showing people the big picture here, and so rather than like as if we're writing a novel trying to build up surprise and a climax here, what I'm going to do is I'm actually showing you here at the end here essentially something that we're pretty excited about. Because at the end of this, I'm going to go through a whole bunch of lay the groundwork for how this trade works and the various expertise that we're going to bring to this. Because at the end of this, in about 2 weeks, we're going to start sharing all of this with our subscribers. So it's not just going to be data from the Stock Earnings website, which is great unto itself, but we're actually then going to start to bring in a whole bunch of trading metrics and trade construction and experience, and essentially to sort of point you at basically how to set up trades here, as opposed to just simply having raw information. So one of the things that we're actually going to be doing is, in fact, providing email as well as phone alerts once we get everything set up here. So this is just a little picture of my phone here from a few days ago, and you can see this is what the Stock Earnings standard alert that I got was, and it just outlined, okay, various symbols that were going to be announcing earnings. Okay, but in fact, we're going to be beefing this up, and so at the end of this, you're going to be seeing stuff that's going to look more like this, and this where you're going to essentially see here's a symbol, here's the date of our research, here's when the earnings announcement is. You're going to see something that talks about an adjusted implied volatility rush cycle, which I'm going to explain in about 5 minutes here. And then also tell you, okay, essentially, here's a type of position that you're going to want to set up. More importantly, we're going to also tell you when to actually get into this trade, because one of the things that we've discovered, and I've been studying for years, is bringing timing elements into this thing. And there's all kinds of guidelines for getting into trades. But in fact, I've been working on for the last couple of years very specifically timing elements, because one stock differs from another. And as a result, to do the implied volatility rush trade with Google, it's going to be different from Netflix, it's going to be different from Apple, et cetera, et cetera, et cetera. And that's because they all have different timing elements to how they behave. We're going to be sharing all of that with you. So it's not just that you're going to have a strategy, but you're actually going to know how to optimize it by actually knowing when to get in the trade, and of course when to get out. And of course this is all predicated on getting out right before earnings, because that's when the implied volatility, of course, is going to disappear. So we get out right before, but in fact there's a range of when you can get out. So I'm going to go through all of that as well. But anyway, I just wanted to kind of give you a heads up that this is what's in the offing. And very specifically also, there'll be great stuff that'll be on the website. So you can either do it on your own, but in fact, Stock Earnings, Ryan and I will actually be contributing trades and setups. And so we're pretty excited about all of this. Just to be very clear, just so we're on the same page, a real quick review on certain things, because that's the setup for the motivation of why we actually love this trade. As most of us know, price earnings, earnings announcements, they're highly unpredictable. I mean, I could tell you tomorrow that Tesla would be releasing I could give you their exact revenues and their exact EPS numbers, and you would not know how to trade it. Why? Because there's the consensus number, there's the whisper number where writers actually have an opinion, but it might exceed the consensus number. So as a result, the EPS exceeds the consensus, but the EPS doesn't meet the whisper number, and the stock crashes. Or it has something to do with sentiment, or they give bad guidance during the earnings call, or they say, okay, they're going to be slow in manufacturing. So even though they hit all their numbers, they still get decimated. And then there's the company sentiment, and then of course there's just geopolitical events and things that are going on with Little Rocket Man and the guy with orange hair. So for all of the above, earnings trades, when you're trying to peg direction, are very, very difficult, and to some degree you're trying to make an intelligent guess and then making your strategy conform to that. And of course that's why we do straddles, and they're perfectly fine, and I do them myself. But I have to tell you, this and the volatility crush are my two favorite trades. And the reason for that is that implied volatility as opposed to price in the big picture are very predictable. They regress to the mean. They inflate ahead of the earnings announcement. They go through a couple of waves from the previous earnings announcement through the 90 or 100 days in between each of them. And so in a sense, they're in a big picture predictable. However, where they are not predictable is literally how much they move, when does that rise towards that kind of crescendo of implied volatility, when does that actually start? And so as a result, you have situations where, in a sense, you don't really know what it's going to do. But in terms of the implied volatility, you do. It's just a question of the where, of the when, and the how much, and that you can actually find from history. And so that's what we've been working on, and that's what I've been working on for the last 2 or 3 years. And I brought this to my trading, and I'm actually pretty excited and anxious to start sharing it with you guys. Okay, what drives, of course, this is that the demand for options increases either through the anxiety of people or institutions that are holding positions and are afraid of what's going to happen when the earnings announcements comes out, and of course anticipation in terms of how speculators. But all of that drives the demand for options, and that in turn drives supply and demand, and then drives the implied volatility. As I said, two of our favorite trades is the volatility crush and the volatility rush. Ryan kind of went through before the crush, which of course is that once it runs up, basically like air coming out of a balloon. Basically when the earnings announcement comes out, pretty much the air comes out of the balloon there. Similarly, the volatility rush is that long protracted period that goes on for weeks, where in the big picture you get that inflation that goes on. And so as a result, this is a classic example of, in a sense, buy low and sell high. And you can basically see this in a chart and when you chart implied volatility. I'm going to show that to you in a couple of minutes here. One of the things in terms of what we want to do, though, is we want to be selective in what we trade. Because in a sense, there's obviously thousands of stocks out there with options. But what we like to do is we generally are trading major companies, liquid stocks with at least 1, 2, 3 million shares, average daily volume. And the reason for that is that you basically get better execution. If you're trying to basically hit the mid on an options trade, you're going to get very close to that. Here and there, you may have to give a couple of extra pennies to the market makers, but essentially, you're not trading something that's like 10 by 12.50, where you're basically dealing with a 25% spread. Those are very, very difficult trades to actually succeed with, and I don't even bother. It's just in a sense an utter waste of time. I know when I'm overmatched, and I would much rather just take the low-hanging fruit. And so essentially having, trading something where, the spread is 111 by 114, 111 by 113, that's more my speed. And I suggest that when you guys do that, you really should be doing the same thing. You want to have stocks that move both ahead of the earnings, in the period ahead of the earnings announcement of, let's say, in the 20 days before, but also, and then also having a very, usually a dramatic move, oftentimes right ahead of the earnings announcement, sometimes in the day leading up to it. That often happens as people speculate. They think that they know something. And so as a result, they kind of, people kind of take a shot, and they think, okay, Tesla's, gone up the last couple of earnings announcements. I like Elon Musk, so I'm going to take a swing. And so as a result, that tends to drive price one way or the other. And so as a result, but however, having said that though, one of the things, and I use stock earnings for, is of course just to look for that higher, looking for those projected one-day moves. Generally, I'm looking for something at least in the 3%, if not 5% range, because those are the stocks that primarily are basically going to feature that huge surge in implied volatility as you lead up to the actual earnings announcement. As I said before, those essentially are are some of the initial guidelines, and then there's going to be a few more that I'm going to present. But the thing that makes this tick, and the thing that we're going to start to present to you, is very specifically these tendencies and these rhythms. Tendencies are, as I put in the example there, something that, let's say, a stock, shows a 3% rise, for the last like 80+%. And so that's a tendency, okay? But then the most interesting thing are these rhythms. Basically, you have the same general behaviors. However, they will essentially start at different times. They will go for different periods of time, and the magnitude of how they react are all different. And I'm going to show you a couple of examples of using Google and Netflix, and I can't remember what the other stock was, on Amazon. And I'll kind of go through those, and you'll see in black and white really how these things different. And once you have a handle on these differences, that actually will give you, first of all, it'll give you better candidates to trade because of the fact that A, their behavior is a little more predictable. B, you'll see where there's actually a bigger room for profit because of the fact that this thing is going to, that knowing when and knowing how its implied volatility has behaved over the last 16, 24, 30 quarters, and seeing the evidence of how that behaves, you'll actually see, and basically you'll be choosing better candidates to trade, and then they'll become a little more predictable because essentially you're going to have a handle on when are things going to happen in relation to these stocks. And of course, the beauty part of earnings announcements is that they all have that one. It's kind of like, think of it as almost like a golf on a flagpole on a green. The flagpole, of course, is the date of the earnings announcement. You've got that fixed point in time, and everything else radiates from that. And so I'll show you how everything essentially radiates from that, and then how you can then bring that into your trading. And in addition to the rhythms and the tendencies, the other thing that we're going to talk about is essentially price action. It's not specific in the sense to earnings announcements, but in fact, it will then, depending on your read of price action, it can then dictate what strategy you use. And if you do have a good handle on price action, not only can you then trade the IV rush, but in addition, you can bring a price action component into that and make it more profitable, because not only will you have the rise of implied volatility working for you in the trade, but then you'll just actually have delta working for you in the trade as well, and that is the movement of price as you in the days and weeks leading up to the earnings announcement. So anyway, so here are some more of the guidelines, and then I'm actually going to, and of course you guys are going to get copies of all of this. But basically, what we're going to do is we're going to look at what the IV cycle is for various stocks, and this is what we've been doing here, and I've been doing personally for the last 3 years or so. So we'll be talking about that, as what in terms of the cycle, in terms of how price moves, how implied volatility moves, when it moves, how it moves. And then I'll show you again how does this actually, how do you bring this into your trading here. And then there's also something where we understand where the implied volatility is in relation to how it's been for that stock over the last, let's say, year or so. And so as a result, there's kind of a relative rank of implied volatility. That also helps you to determine if you're going to do the IV crush, is implied volatility relatively high at the moment in relation to where it normally is for this stock, or is it kind of low? Needless to say, if it's kind of low, more often than not, it has more room to move. If it's already inflated, then that means that it could be a good trade, but it may not necessarily be an all-star trade, just because you're starting at a much more inflated value. I'll show you how to read that stuff. And then again, like I said, bringing price action into this, as well as that allows you to have a positional bias, and it essentially gets you, it allows you actually to do a more aggressive trade, because if you don't know really where price is going to be moving, well then effectively what you want to do in the trade, of course, is to neutralize price, to make something, essentially kind of reduce the effect of delta. And obviously a straddle is certainly one way of approaching that. And something essentially, again, that will either neutralize delta or bring it down to a relatively low level, so that price moves one way or the other aren't going to affect you tremendously. And then at that point, then you're basically profiting from delta. Excuse me, from the implied volatility. This is a Post-it that's sitting on the bottom of my my monitors, and it's, as you can see, it says "Don't cheap out." I just showed you and explained to you how to make money with this, and I'm going to obviously start to show you the steps in a couple of minutes. But the other thing is, you also have to remember with this trade, you're in it for a long time. You're in this for sometimes 3, 4, 5 weeks as the volatility kind of grows here. So as a result, one of the things that we do is we want to make sure that we're not getting crushed by delta, excuse me, by theta, in terms of time decay. And so we're going to talk to you when I show you how these trades get constructed. I'm going to show you that basically what you're going to want to do is actually buy more time than you really think you need. Because really, when you're up here, and if you know anything about the options Greeks, okay, when you're up at this point, theta is actually relatively benign. The time decay is relatively friendly here. It's not going to decimate you. So you may lose a penny and a half when you're let's say when you're 2 months out. On the other hand, when you're 3 weeks out, 2 weeks out, 4 weeks out, now you're down here, and now you're losing 3, 4, 5 cents a day. As a result, what you want to do when you get into these trades, and if you're doing something that involves a spread, or even if you're just doing, let's say, a straddle, or buying a put or an individual put or a call, you want to buy them 90 days out, 120 days out. Yes, they cost you more, but at the end of it, when you close the position, you're going to get back more, and you're going to lose less on the implied volatility. You're going to lose less on the time decay. So in one case, you may spend $1 on time value. Another case, you may spend $2.50 on time value. But in fact, what's going to happen is, in the case where you spend $2.50, you may only lose 30 or 40 cents of the time value. In the case where you spend $1, you may lose 85 or 90 cents of it. And consequently, yeah, you spent less up front, but at the end of it, you got back far less and you lost far more. It's kind of like life. It's the difference between cheap and value. And that's just an little indication of that here. So you want to basically, if you're going to be buying options, you want to be buying them up here. When you're a seller, you more often than not, you want to be selling down there. So again, don't cheap out. And between now and then the follow-up seminar that we're going to be doing in a couple of weeks that we'll outline, we'll go into this in greater detail. So what I want to do now is I want to show you, what I'm talking about here on a number of these things. So this is a chart of Amazon, and up on the top, obviously, we're just looking at a price chart here, and at each of these dotted lines, and where this big fat blue dot is, and maybe I guess Amazon is now done, I think, finally with the red dots, which would have signified losses. So each of these represent the date of an earnings announcement, and that number, of course, is just the EPS number. I really don't care about it, but it's there. So at any rate, this represents the earnings announcements at each time. What we're looking at on the blue chart at the bottom is essentially its implied volatility map. And so, as you can see, what I've done is I've aligned the date of the earnings announcement from the price action. I've aligned that precisely on this, where you see implied volatility, and then at exactly the same point in time. And what I'm going to do is I'm going to blow this thing up now. And what we're looking at here is essentially the climb in implied volatility from trough to peak. And if you notice here, if you look at this kind of trough here up to the peak right before the volatility crash at the earnings announcement, it basically took 44 days, and the implied volatility ran up 61%. Now, just to be clear, we're talking 61% in relationship from the implied volatility. In other words, if it's sitting at 18, okay, it went from 18 to about 20 to 26. That's the 61% move. Doesn't mean that it went from 18 to 79. In other words, in terms of the percentage of absolute volatility, it's the percentage of the percentage. Okay, over here from trough to peak, okay, this thing exploded over 4 times. Notice the trough to peak, 45 days. Over here, 53 days. Over here, 47. Over here, 49, 42, 44. Okay, and then back here, 36, 34s, and these are all in the 30s. If you notice, they all kind of cluster around that kind of 45, 46, 44, 43. You're starting to find a kind of a periodicity here, where it kind of moves relatively predictably, and and of course at varying degrees of how much IV explodes. Now, there are times that what I've been doing is over the last 2 or 3 years, I've just been mapping this out, both on an automated fashion as well as manually, just hundreds and hundreds of stocks, and as well as ETFs, to try to find, kind of figure out where the sweet spot is to actually get into these trades. Because in a sense, if you get in, let's say if you got in too early, and let's say if you decided, okay, well, I'm going to get in, because some people will say, oh, you get it 50 days ahead, 40 days ahead, 30. Well, if you got in here, obviously, you're gonna watch IV first crash on you a good 20%, because it's going to go from basically 25 to 40. Excuse me, 25 to 20. Okay. Well, over a period of time, I've been finding that a number of these stocks have a fair amount of regularity here. And so what I've been doing is working on figuring out where is the maximum safe spot to get in. Doesn't mean that you're going to maximize the implied volatility, but what it is that, okay, where is essentially the latest safe spot where I can get in, where it looks like I'm going to capture a nice healthy chunk of IV. And that's what this is what I've been working on for, like I said, probably about 2 or 3 years here. Here's another example. Here's Google. Again, same thing. Price chart, and then right underneath it, of course, is its implied volatility. Again, from trough to peak, 38 days, 41, 37, 36, 43, 31. Incidentally, these numbers get adjusted because more often than not, the companies are announcing, 90 days ahead. The spread between the earnings announcements are obviously quarterly, so that should be approximately 90 or 91 days. On the other hand, oftentimes at the end of the year, Sometimes because of the holiday season, they'll add on, and there'll be an extra week or two in between. So consequently, we're around Easter, so consequently you need to make an adjustment. So for instance, like right here, you'll see April 21st, July 28th. Well, right there's actually an extra week. And so if you looked at this 43 versus 31, well, that sounds like a huge difference. But in fact, you got to make an adjustment here. So again, what we've been doing is compiling these and finding stocks that essentially have some regularity in terms of this kind of data. And so as a result, we can see 36, 37, 41, 38. And like Olympic diving, if you've ever watched the Olympics, they always say, you throw out the high and the low, and then you average the other six. And of course, what we do is, of course, we also give greater weight, of course, to the most recent ones. Okay. So and you can see on some of these, like if you go back in time, you can see that the periods on some of these are much less. I think on the Amazon one before, it was like in the 40s, but then about 2 or 3 years ago, it was more like in the very low 30s. It changes over time. But for this, if you understand what's going on here, what this is giving you essentially a good spot to actually get into the trade. Okay. Now, if you notice here on this one, you may say, well, why don't you get in here, all the way down here? Okay, this would require you to get in, obviously, probably a good 10 weeks, 10 days, 10 or 14 days. Well, I don't know that this is going to happen in advance, but I do know from the track record that kind of that number in the low 30s kind of gives you a roughly a safe spot to do it. So you're not always going to optimize what you're doing, but you are going to get in at a decent spot. It's kind of like it's almost like buying from Amazon. Amazon, you generally always get a pretty good price when you buy stuff. You don't necessarily get the absolute best price. I'm sure if you roll up your sleeves and you spend 20 minutes or a half an hour going from website to website, you might be able to get something for 5% less. But your time has value, and there's a sense of reliability in your bonus points and Amazon Prime or whatever. So people just kind of go, okay, I'm getting a pretty good. Well, that's kind of what's going on here, where you're going to get in at a roughly a good price, and more often than not, you'll capture a decent chunk of the implied volatility. Okay. So one of the other things that we care about, of course, once we got the period of here and the span, is the ones that actually have the bigger numbers, because these larger percentages, of course, result in a greater IV inflation. So if we go back to, I think it was the Amazon one, okay, you can see these all are in the This is like in the 60s. This one's basically 2.5 times in the 70s. Okay, so 122. So that's the other thing that we're looking for, are what are the mean. What we do is look at both the average and the mean to kind of figure out, well, which ones have kind of the larger expansions, the larger inflations of implied volatility. All of that feeds this trade. So what we're doing is we're putting together, we basically have a watch list of stocks that have a certain relatively reliable average period to get into the trade, and then kind of a ranking of number of companies that, let's say, where the implied volatility explodes by 50%, 100%, 125%, and needless to say, generally the bigger the better. And if you know anything about options, the more irregular the better. Because if you always knew that the implied volatility was going to probably burst, let's say, go up by 120%, well, effectively, it might not do that if somebody could really detect a pattern. A lot of times it's the irregular behavior of a stock and an option that also helps to actually fuel the volatility, because in fact it's unpredictable. So we've been compiling all of that, and that's going to go into these trades here. Okay, so here's Nike. Here's another one that I've been looking at. Okay, and you can see right here Okay, this one in particular. Notice this one. Okay, in this particular, I'm using a different application here. Okay, if you notice here, in this case, this red line here is the implied volatility. The blue line is historical volatility. So the implied volatility, of course, is key to the options themselves. Historical volatility, of course, is key to the underlying. Okay, so interestingly enough, notice this one pops 55 days, 55 days, 54, 54. These are all reliable spots to get in. But here's the interesting thing that caught my eye about this, and it probably maybe would catch your eye as well. Here's the earnings announcements. Notice when IV peaks on Nike. Always, let's say 4 to 6 days before the actual earnings announcement. So if you notice, here's the earnings announcement on 9/27, but in fact, vol basically peaked at 9/21, 6 days before. That kind of flies in the face of generally what one expects. But you know what? It is what it is. And so it's kind of like baseball. Sometimes an umpire has a strike zone that may not necessarily be by the book. It may not be between the base of the knees and the armpits, but as long as you know what the rules are, a good batter will still be able to succeed. And to some degree, Nike kind of, to some small degree, is kind of atypical because, again, it peaks. So here's the interesting thing. If you're going to get into, when we do a volatility rush trade with Nike, in fact, rather than kind of pushing this thing almost to the point of the earnings announcement, in fact, the tactic will be, in fact, probably get out 4, 5, 6 days, maybe even a week before the earnings announcement. Why? Because history shows us time after time after time, this thing peaks a week before, 4 to 5, 6 days before. Here it is, time after time after time. I was kind of surprised when I saw this, but again, that's fine because essentially that gives me, and I've had, I think, a couple of trades ago, it worked like a charm to the day. I don't understand why it behaves this way, but it does. Excuse me. So one of the things that we're going to bring to you, one of the things that Stock Earnings is going to bring to you going forward is the inclusion of this kind of information on the website. And we're also working on a means of delivering phone alerts about this stuff. So if we say, okay, look, you want to get into a trade, you may want to get into it, 50. Here's the earnings announcements. Well, you want to get in between 52 and 56 days before. So here are those dates, and here's how much implied volatility it is, what the rise is going to be. Here's how much, and here's a particular strategy. And so what we're going to do is we will match up what its profile is in terms of of what its IV rank is, in order to kind of maximize and essentially kind of come up with essentially a trade that will capitalize on both the implied volatility inflation as well as potentially the price action. In the couple of minutes that I have left here, though, I want to show you, one of the things that you can do, of course, is buy puts and calls for these. If in fact you're looking at a positional trade. On the other hand, if implied volatility is relatively high, well then what you might want to do is do a spread, because essentially that will allow you to then because the options are going to be somewhat expensive if implied volatility has already started to inflate significantly. So you could basically do a debit spread on that. And of course, if you're in no man's land and you don't actually have a positional thesis on the stock, you may just want to essentially do a straddle where you sort of neutralize the effect of the price move. Let me just show you something here. Here's something we're looking at on Lulu here. Okay, so here's the trade plan for this. Again, this is an example. It is for educational purposes only. This has not been finalized. I'm just using this as just kind of a rough example that I kind of threw together today. This is not a live trade setup by any stretch, because there's a couple of things I still have to do here. Okay, but basically, based on its IV rush cycle, it basically is running on a 29-day cycle plus or minus 1 day. So that's a pretty narrow range, obviously, 30 to, basically 29 to 28 to 30 days. And basically, what I'm going to be doing here, if in fact this thing fully qualifies, is if price comes down to this particular level here, I'm going to make this a positional trade, and as well as capitalize on the expected pop that's going to happen when price bounces off of this level and then resumes its upward path. Similarly, if price comes up to this level that's sitting above current price, I'm expecting price to actually get smacked down here. And so I would do a positional trade here. Sorry, folks. And so basically what I will do is so at that point, if it comes to this level or this level, not only can I capitalize on the volatility rush, but I can also capitalize on the price action. On the other hand, if price is just kind of hanging out in the middle here in a couple of days, and I'm just kind of sitting in no man's land in between these levels, then I would probably do some kind of neutral strategy, like a straddle. So anyway, but all of that'll we'll flesh this out in more detail in a couple of weeks. But what we're going to do is we're going to send you we're going to send everybody the PowerPoints. We'll send you some of these slides of the actual live of these charts that we're looking at, just to kind of give you the background on this, and so maybe you can take a look at them. And then in about 2 weeks, we're going to reconvene here again, and then we'll actually build some of these trades, and we'll actually go through the process of looking at charts, looking at the cycles, and then actually putting these trades together. So anyway, I know that was a lot, but I have respect for you guys as traders, and actually wanting to learn, as opposed to just hearing somebody going, well, I'm right 93% of the time, and here's a right side up green triangle, and just buy here, and you'll make $1 zillion. That's not how we roll here. And so as a result, we want to share our experience with you guys, and to frankly put some meat on the bones here. So with that, I'm going to hand this back over to Ryan, and I look forward to seeing you guys in a couple of weeks. And like I said, I will be sending you we'll be sending you out the slides, as well as some of the chart screenshots. So anyway, take it away, Ryan.
Mitch, before you do that, can you see the questions, or would you like me to just read them off to you?
Let's see if I can see the questions.
So
I actually can't. For some reason, I'm not seeing the. Oh wait, here we go. Let's see here. New software will be able to search for 3 weeks. Okay, well, there's some software-related questions here.
Yeah, that I already answered it actually about the screener part. So yeah, then a screener, that new screener which is gonna come out, we're gonna able to screen as far as 90 days. So that's gonna be very good. And another good thing is about screener is that you're gonna able to save a dynamic screening. So that's another good. Actually, next in 2 weeks we're gonna do another webinar. In that webinar, we're also gonna go over some important features about new screeners. So in that webinar, we're also gonna cover that part in more detail.
Okay. Let me just quickly address some of these questions here. Somebody had asked, would you sell the spreads before the close on the day of earnings? Well, first of all, let's be clear. You want to sell it before earnings. So if it happens to be that there's the earnings, as you know, of course, a lot of companies, they announce before the market. So if somebody's announcing on October 31st, you generally want to be out by October 30th. Having said that, though, there are times, in fact, that like for instance, a perfect example would be that, what we were just looking at, I think Nike, where Nike, was in Nike or Amazon, I can't remember really, which is the one that, where in fact it peaked, implied volatility peaked 5 days before. So in fact, based on that cycle, I would actually get out 5 days before the earnings announcement. Why? Because the evidence shows that that balloon inflates, kind of deflates, I should say, prematurely. But yes, as a matter of general principle, absolutely, you want to kill the because this trade is predicated on IV inflation, and consequently, the implied volatility comes out of the balloon once the earnings announcement comes out. All the uncertainty comes out at that point. So yes, you want to kill the trade before that. Let's see, it's 45 days. Everything associated with options is always associated with calendar days. So if you look at your options platform and it shows, how many days to go, that's actual calendar days, not trading days. Okay. Okay, so let me just see here. What else do we got here? Actually, I think that's, at least according to my log here, that seems to be it for the questions, Ryan.
All right, let me make sure we didn't miss anything.
So one question from the Tony Heidi. What is the fee for your service? So we have two plans, monthly and yearly. And monthly plan is like only $20 a month. And for yearly, we have $149 a year, yeah? So I'm also gonna post the link for you, Tony, okay?
There's one more question just came in, Mitch, if you wouldn't mind. When selling the vertical spread, it's right at the bottom. Sorry, Harold just took the screen from me.
Sorry.
Oh, I got it. Hang on. Interestingly, for some reason, it's not showing up here, so if you can just read it to me.
When selling the vertical spread, how are you selecting the position delta of 16?
I'm sorry, when selling the vertical spread, how am I selecting the position delta?
Yeah, it says position. Oh, how are you selecting the positions, comma, delta of 16? Can we? Yeah, I don't understand. I'm not sure I understand the question either.
I don't understand it because, first of all, for this particular, the IV rush is actually a debit spread. You're actually paying to play in this because essentially you're going to, in order to capitalize from the IV inflation, you essentially want to be long the action part of the thing. You want to be long options in this. So I'm a little confused about the question. However, whoever sent that, if you send an email to support@stockearnings.com, send it. It'll get and see if you can clarify the question a little, and I'll be happy to address it.
So Randy, I am typing our email address.
And this goes for everyone.
Yeah.
Send any questions that you have for Mitch. You send here.
Yeah.
Mitch will answer them in great detail and get back to you as best he can. Let me just make sure.
How about can we sell options?
Can we sell options on Friday on expiration day?
So Raj Patel.
I mean, obviously, you can. I have to say that's not my trade because essentially, in other words, you want to sell it in the essentially you're going to sell it. Let's say hypothetically, if they're going to announce after the bell, you want to sell it in the morning because effectively the balloon is basically as full as it's going to be with respect to IV. And the answer is sure. But the thing is, on that last day, options, there's a lot of activity that goes on, and sometimes there's just unexpected stuff happens. It's just not, personally, it's just for me, that's kind of almost a gamble. I like this trade where I've got kind of all kinds of things that I can just kind of line up. And kind of have these nice, safe, reliable income-producing trades. But one can do that, and I mean, but again, there's stuff that happens on that last day, and sometimes it's just unpredictable, including, I'm sure people have heard about this, where somebody hits the button at the wrong, like prematurely. Like I remember HP about 2 years ago, they were supposed to announce after the bell. All of a sudden, 10 a.m. the earnings announcement came out. Somebody accidentally hit the button. I mean, I wouldn't plan my life around that, but again, that to me is just kind of a speculative trade. The other problem with that is that sometimes people think that they know what's going to happen, and so as a result, on that last day, there's going to be a run up or a run or a crash in the price a lot of times leading into the earnings announcement. So you may make in a sense, you could make a fair amount on the implied volatility, but you may get whacked on delta. You may get whacked on the price action, because in the sense you may have, theoretically you may pick up 80 cents. I'm just making up numbers here. You may pick up 80 cents on the implied volatility on that last day. On the other hand, if you're long calls and the price happens to drop $3 and you're running a delta of 70, well, you're going to lose $2.10 of on the price action. So sure, you made 80 cents on IV, but you lost 80 cents on the price action. So again, it's just not my trade. Doesn't mean that there's anything wrong with it, but of course you want to do it right.
All right, Mitch, there's 3 questions I think we should answer, and then we're going to kill it. What if this is pretty common? What if the stock doesn't move in the direction you think it will? But I'll let you answer it.
Well, it depends on the nature of your position. If in fact you do something that's relatively delta neutral, like let's say you do either a let's say you do a straddle, or if you do something that's a gentler kind of trade, let's say you do a debit spread, which is inherently going to run let's say a lower delta. So you may be running, let's say you could run like an 80%, a delta of 80 on a call, but then if you sell a higher call, let's say with a delta of 50, well then you're only running a net delta of 30, so essentially it's not going to hurt you nearly as much. But the bottom line is, if you're running a positional trade, you're going to lose money on the price action thesis part of it. On the other hand, if you're running something that's relatively delta neutral, and that you build it to be effective, essentially a neutral trade, then price action, I won't say is irrelevant, but you can negate it to a large part. And in fact, that's, like I said, when I was showing you that Lulu setup, if price gets to one of those 2 levels, I would do a positional trade. If it's in no man's land in between those zones where I essentially don't really know what the price is going to do, then I gravitate to something where delta is basically neutralized as much as possible, because now I'm guessing at what the price action is, and I don't like guessing.
Cool. And the last question I want you to answer, Mitt, well, I guess I can answer it too, but will you offer earnings plays that will focus on the IV crush, for example, iron condors?
Yeah. I mean, one of the things we're gonna be doing, we're probably gonna focus on pretty much the crush and the rush. The one thing I will say though, and this is just a matter, again, everybody has their own bias. As I say to lots of traders and coaching students and whatever, there's an infinite number of ways to trade. Master one of them. The one problem or the one issue about the crush is that you have to, is that again on that last day, there's stuff that goes on, and I don't know. I just see a lot of irregular behavior. But again, I'm coming at this from an honest bias, and I'm being very honest about it. Having said that, we will, particularly where we can kind of like almost neutralize the price action. We'll be doing the crush trade as well.
Okay.
Cool. All right. I think that's kind of it. The last question, Mitch, is a couple of questions about your IV indicator. They want to know if it's available in Thinkorswim. I believe you have implied volatility and then historical volatility.
Right.
So I guess there's a way to they could probably just leap the 2 of them together in Thinkorswim. Mitch is using TradeStation, so. Yeah,
I mean, put it this way. TradeStation is a fantastic platform. Having said that, it's not the only great platform out there, and one of them is TOS. One of them is Thinkorswim. I have to think just about anything you can do in TradeStation, you can do in Thinkorswim. And let me just throw one little tiny bit of trading stuff, as long as we're talking about historic versus implied. There tends to be a confluence there, and we're essentially where a lot of times the implied volatility will tend to gravitate towards historical. Consequently, if you're looking for the crush, if you're looking for the rush, a lot of times if I see that the historical is sitting above the IV, I usually find that that's just an extra little sweetener to the trade. Because, like I said, a lot of times you will see as the period heads towards earnings announcements, you'll see implied gravitate towards historical.
All right, cool. All right. Thank you, Mitch. Some housekeeping, guys, real quick before everybody leaves. You're going to get an email probably Monday morning. We'll have Mitch's presentation, a checklist, the recording of the webinar. And then I also want you guys, if you guys aren't members, go to our website and sign up for one of our plans. It comes with a 7-day free trial. And you're going to have to be a member to see the new alerts. So go ahead and sign up, as soon as possible.
And here's
then
the
you'll
link.
see there's the link. It's sent to everybody, sent to all. And then you are good to go. You're going to see our new alerts. And you'll get all the good information that you got tonight in copy form on Monday morning.
Yeah, so who are members of our website, they will get the recording as well as the presentation. And those who are just visitors and not a member of our website, they will get only recording. So if you are interested in a presentation, then we would recommend that you go to our website and sign up for the monthly or yearly plan. The monthly is just only $20 a month.
And when the new alerts start, you're going to have to be a member to get those.
Yeah.
So if you're not a premium member, we have no means of sending you the actual alert. So you have to be a member to sign them to get them. All right. Anyway, thanks for your attention, guys. I hope everybody enjoyed the presentation. I know I did. Have a good night and safe trading.
Okay, and how do we stop it?